pretty well. So in that time, it was only 2 years after the big trouble that we got the first big answer. And the answer that contributes a lot for the resolution of the tensions was the outright monetary, the Mario Draghi outright monetary transactions. And with this program, we succeed in easing financial conditions and overcome the worst parts of our tension period. But to come to your question, was now comparing to that time, is it so? If we are
yes,
risking,
so what are the risks, and if you think that
to a similar tension period? I don't think so, because first we have learned from that period, and we know now that the central bank monetary objective is not only price stability, the stability of the financial market and the good function of the monetary policy channels, the channels by which the impulse are communicated to the economy are very important as well, and because we have learned, and because unconventional monetary measures have been have shown that they are very helpful in a time where interest rates are very low, and precisely traditional, conventional monetary policy is no more effective, because it's not useful to steering short-term interest rates to aim price stability, because it won't work. And because we know all that, I think no one, it's say too much, but most of the European countries involved in this project don't want to return to the same errors that we made that time. And even, knowing that we are now phasing out some of the asset programs, in particular the pandemic, emergency pandemic purchasing program, we know that we have to keep, and we have other alternatives, other unconventional measures that could substitute this type of program, measures that don't have impact on liquidity, like precisely, for instance, the program I mentioned, the outright monetary transaction program that was launched at that time. I don't know if I answered your question, but...
Okay, thank you. I think we have Vítor Constâncio with us again. Can you hear me? He was.
Hello?
Yes? Oh, okay,
Can
perfect.
you hear me?
Yes, perfectly.
Can you hear me?
Yes, yes.
Yes.
Hello?
Can you hear me?
We were talking about this current situation in inflation, and how do you see the future, the near future of monetary policy, and this current debate in some countries between what should be the correct sequence between starting increasing interest rates, or first phasing out all the quantitative easing programs? What do you think about this?
Well, one has to highlight first that for many years now, the ECB has been committed to the sequencing of starting with the winding down of the large purchases of securities, and only after that ends starting to increase interest rates. There is some logic to this sequencing because the interest rate is the traditional and more significant instrument that central banks can use, whereas the large purchase programs of securities were exceptional, non-conventional measures, and if the situation starts to turn around and instead of very low inflation, there is a threat of higher inflation, then it is logic that the exceptional, unconventional measures that were taken in times of very low inflation would be the first to end. And that is more or less what is going on with the announcement by the ECB in December of the end of the pandemic emergency purchases by the end of March.
You wrote a tweet last week when the ECB published this decision, saying that these current inflation rates in Eurozone are mainly supply side pressures. Do you think that you should not be worried about inflation right now? Do you think that you should not be worried about inflation right now?
Certainly, inflation started to reach concerning levels in the second half of last year. Because until August, inflation was below 2, or more or less 2%, I think in July. It was only after August that it started to creep above 3 and then 4, reaching then 5 in December and 5.1 in January. So it's always a cause of concern, but it is true, and I hoped to show that in the slides I prepared for the panel, that indeed inflation, particularly in Europe, is mostly due to energy prices. To give you the numbers, the total inflation rate in January over January of last year was 5.1. But if we take out energy, then the rest of inflation of all the other goods and services was just 2.6. Because the energy products in the price index increased 28.6. So without that huge jump in energy prices, we would have a much lower inflation, and that's quite clear. What happened is that the price of oil went beyond what would be only a recovery of the big decline that the price of oil had in 2020, and at the same time there were geopolitical reasons for the price of natural gas to increase in Europe very much, because particularly Russia was restricting the amount supplied to Europe of natural gas. And since 2014, Europe, and particularly Germany, oriented energy policy to use more and more natural gas, and so the effect was very important. So far, in the euro area, we cannot see that there is a situation of, say, excess demand that is it's really influencing the inflation rate, and also we don't see wage increases that would also justify the high inflation that we have. The situation in these two aspects is totally different in the US, and that's why the Fed has many more reasons to really change policy and beginning to effectively tighten and very likely to increase rates in March. I don't see that need in the euro area in March, certainly. Also because there is the sequencing. The ECB is committed to end all purchases of securities before it starts to increase rates. And in December, and just last week in the meeting of the ECB, it was reconfirmed that the plan for the ECB is that when through the PEP will end in March, then the ECB will continue to purchase something under the other older programs to the amount that was reaffirmed last week of 270 billion of euros. So that was still the commitment. And these would have to be totally then changed and ended the purchases before the interest rates could be increased. So this commitment is already there. And also the commitment that under the forward guidance that the ECB approved last year in July, that interest rates will only increase when three conditions will be met. And the conditions are, the first one, that the inflation rate is already at 2%. And that the projection for inflation till the end of the horizon of the projections also shows 2% inflation or higher. And third condition, that the core inflation, the inflation excluding energy and unprocessed food items, that core inflation would be at a level that would be compatible with the idea that the headline inflation is converging to 2% on a stable basis. Those are the three conditions. And so far, the projections until 23, 24 do not show that inflation would be at 2 or above 2%. So the conditions that the ECB defined itself in July of last year to increase rates are not yet met. Well, we have to wait for new projections, but internationally, all the projections that have been produced and published show that for the euro area, inflation in 23 and 24 will be still below 2%. So that is conditioning, of course, on the energy prices started to decrease. And these supply shocks, energy prices and other supply shocks linked with supply chains cannot last forever, almost by definition, because for these shocks to continue to influence inflation, they would have to happen every year. Inflation is a flow, is the change of prices. And for energy prices to continue to increase the inflation rate or keep it at 5%, for instance, it means that on average energy prices would have to increase by much more in 22, 23, 24. And that's not likely because the economies would decelerate their growth. By the way, the growth in the advanced economies is already showing some deceleration, and if they would decelerate, then the increase in prices of oil would not be possible to continue in the same way. So indeed, one has to expect that in the second half of this year or next year, we will have a different situation in terms of these supply shocks, in particular energy prices. And that's why all projections by all international institutions so far show inflation below 2% in 23 and 24. And if that would continue to be the case, then according to its own forward guidance, the ECB would not meet the conditions to increase rates. So we will see developments, of course. No one knows what is going to happen to the energy prices. But for instance, if the situation of the tensions between Ukraine and Russia, or rather Russia and Ukraine, would disappear, that would contribute to certainly a significant decrease of energy prices with effects on inflation, particularly in Europe. So we don't know what will happen. There is a lot of uncertainty, particularly around these geopolitical questions. And in such situations, it is common sense that we should not make decisions that are too committal, too significant. We should be cautious because we cannot see what may happen in not so distant future. So everything has to be gradual, and in view of all the other conditions regarding sequencing and regarding the forward guidance on interest rates, all that goes in the direction of the ECB having to be very cautious and respect the conditions that it has defined itself.
Thank you. João Amador, this phasing out of the quantitative easing in Eurozone can contribute to some financial turbulence in the markets and in the economies, or can be managed in such a way that is to avoid that kind of consequences?
Yeah, that's the $1 million question. So that's the trade-off that is being faced. So I think we have more experience now regarding how to deal with turmoil in financial markets. So we've had this previous crisis. I think that overall the central bank is more prepared and there are more tools available to deal with that. So that's good. So experience, as we said earlier. So we have learned. There are some additional fragilities now because we have higher levels of debt. So that makes everything more demanding. But in some way, there's also more debt in all the countries. So it's probably, okay, more debt, but it's not kind of concentrated in a small group. So it's easy to target one country specifically because we have higher debt. So in this way, it may be easier to manage. But the big question is there. I mean, with such high debt levels, with so much liquidity that has been accumulated, with all these prices of assets that have been increased so much, what may happen if agents revert to expectations into this idea that monetary policy will go for a more contractionary stance? So this is the big challenge, to be able to switch in a cautious, smooth way so that there's no major turbulence in the financial markets. And gradualism in the way things are being decided, as Governor Constâncio was saying, it's the key. Whether we can actually do it smoothly, it's always there's a big question mark. I mean, financial markets are not well known for their soft kind of adjustments. They are known for adjusting fast and abruptly, though this is difficult. But I'm sure that the ECB, central banks in general, are quite aware of these risks. Quite interestingly, in the revision of the strategy, it was also said that financial stability is a precondition for price stability. So this is basically saying that the central bank will be paying a lot of attention to what is going in financial markets in order to avoid disturbances, because it is clear that if these disturbances take place, the idea of price stability in itself is not there. It's harder to get. And then, again, just finishing by saying, then this does not mean that we shouldn't be worried with the sustainability of debt, notably public debt. That will be on the table always, and this idea of having monetary policy kind of following fiscal policy or the reversal, which is dominant here, this is on the table, and this calls for strong cooperation and strong dialogue between fiscal and monetary policy authorities so that these things can go as smoothly as possible. It is obviously very hard to conceive a scenario where financing costs for governments increase a lot with these very high debt levels. It will be, of course, hard to manage this kind of circumstance. So, not an easy trade-off, but I mean, I'm confident that we've learned enough to deal with it, and financial markets hopefully will also, in some way, cooperate and avoid these kind of very strong and disruptive reactions.
Okay, thank you. Let me just try to contact Chiara. Chiara, are you listening? Let me just try to contact Chiara. Chiara, are you listening?
Yes.
Okay.
I have about a 5 seconds delay, so I'm listening.
Okay, just do one
I'll
last.
just be a little bit slow.
One last question before opening some questions to the audience. How do you see this situation in these current pressures in the prices, and how should ECB, in your opinion, deal with this sequence in phasing out quantitative easing program, at the same time preparing the further increases in the interest rates?
So I will paint in the gaps of what Professor Constâncio already kind of at broad strokes described. And I would start from the 3 aspects of our forward guidance, which is that we expect or we will, sorry, I have echo. It's a little bit different for me to speak because I have a little echo, but bear with me. I will start from forward guidance, which says that the ECB needs to see inflation reaching 2%. Number one, well ahead of the medium-term horizon, which the policy looks. It has to reach 2% durably for the rest of the projection horizon. And also, we have to see progress in underlying inflation that is sufficiently advanced to be consistent with inflation stabilizing at 2%. So let's unpack this now. Of course, we are seeing inflation above 2%, well ahead of the end of the projection horizon. We are not seeing it durably above 2% because, as João earlier was saying, our projections, and not only our projections, but also projections by other professional forecasters, the inflation in the euro area kind of still below, as well as market inflation expectations and the survey of professional forecasters. They all see inflation kind of tending to 2% from below by the end of the projection horizon. But then the really key issue for us is how do we judge the progress in underlying inflation, whether it is sufficiently advanced to be consistent with inflation stabilizing then at 2%. And the key for that is the behavior of wages. Because as Vítor was saying before, we now have 50% of inflation and above that is energy prices. Now I'm saying 50% above because mechanically the contribution of oil prices, basically what we call energy in HSEP, is above 50%. But you also have impact of energy prices coming via the food prices, because food are very intensive, say in fertilizers, in energy, in transportation. So energy prices also hit us through food prices and other prices. So we also see prices of non-energy industrial goods higher than usual. But will this dynamic of prices become encroached and self-sustained? So for that to happen, it would have to feed into expectations, and expectations would then have to feed into the next round of pricing. And for that, the most central price that we have to look at is wages. And I would like to bring in now the comparison with the US. No? So in the US, first of all, the stimulus was much more. The pickup of wages was faster and more advanced. The US economy is not only at the same level of GDP as we had in 2019 before the pandemic, like we are now at the same level, but the US is even at the same trend. No, so it's not just that you want to be back 2 years, but you also want to kind of catch those 2 years, and you also want to look at what we call the output gap, so the distance between the current growth rate and the potential growth rate of the euro area, and we're not yet there. And unemployment has now become very low, but what we don't see yet is the signal of the recovery of the economy also showing up in wages. And even less are we seeing demands incorporating the inflation that we had in 2021. Now, what kind of wages do you want to look at? We want to look at, say, we have two measures that are our usual measures, which is per head and per hour. They have been very distorted in the euro area relative to the US because we have job retention schemes. So in the US, it was very easy, just fire everybody, rehire everybody. But when there was this demand for labor, now everybody who has to be rehired is asking for much higher wages. And that's how the US labor market works. The euro area labor market, with differences, of course, between countries and between sectors, but by and large, it was not decided to fire everybody, but rather to subsidize the maintenance of the labor relationships of firms and employees. So the hours went down, potentially to zero, and now we have this distortion. So what is where can we find the signal? It's in negotiated wages. Again, a difference with the United States. We have much more collective negotiations of wages in the euro area, in all countries really, of the euro area than in the US. And that is where we can see, and we have to trace the wage demands on one side, and then at the end of the negotiations, the wage increases that will be locked in by labor versus the firms. And then the next point is also, even if we see wage demands that are much higher than usual or much higher than now, will those negotiated wage increases be achieved by one-off, kind of cash in 2022, or catching up with the extra expenses, say on energy and food, that occurred in 2021 and 2022, or will they be in the base wage, so locked in forever, so to speak? So that is something to be very mindful of, and that's the central thing that we have to see, whether there will be signals of what was called, when even I was young, a wage price spiral, right? So we don't see that now from the two indicators we look at: the inflation expectation, 2-year long-term inflation expectations still being at 2 and not above, and the wage demands not being of the same kind, with the same dynamic that we see in the US. That said, negotiated wages in particular are a lagging indicator, so one has to be also careful not to disregard other indications that these expectations of higher inflation may become encroached. So this is for the part on the diagnostic of inflation, so to speak. But then you also asked about kind of the the moment in which, if we determine that there is a risk indeed that inflation overshoots the target on a sustainable basis, I would totally agree with what was said about the sequencing. No, the sequencing is important. It's not random. The point is the asset purchases act along the whole yield curve. No, the idea is to subtract risk, duration risk. So it tends to flatten the Phillips curve. Sorry, the yield curve. Then, does it make sense to send at the same time two different messages? One is I keep buying, so I keep operating along the curve and keeping it relatively low, but I raise interest rate. Doesn't it run the risk to confuse markets and to create an inverted yield curve that is usually a signal of recession? So the information extraction of what the ECB wants to do by the part of markets with an inverted sequencing or with throwing away the sequencing would be problematic in terms of financial stability. And indeed, this is to maybe complement, or at least from my point of view, a complement to what João was saying about the financial stability. And it's very true that the strategy review has kind of incorporated the concept that financial stability is a precondition for price stability, and it has also incorporated in the functioning of the Eurosystem a lot of joint analysis of financial stability and monetary policy outlook. But one very important difference relative to the crisis of 2008 and even the crisis, the second crisis, no, the sovereign debt crisis, is that the EU has been building institutions. We went into the first crisis with no SSM, no, with totally fragmented banking supervision. We started to build ESM. We didn't have something like OMT, and we didn't have the infrastructure, not only the consensus building, not only the concept of how you do asset purchases, quantitative easing in a monetary union, but even the technical infrastructure was not there. So now we went into the COVID crisis with a joint supervisory mechanism, joint information about the banking system, which has then favored a much more sound banking system, more able to tolerate risk. We have an ESM, which, if, God forbid, we have to resort at some point in the future, far future, possibly never, to OMT, then we have also ESM that can help in managing the OMT. So we are in a very different situation in terms of being able to address financial stability risks than we were in the previous two crises of 2008-9 and then the sovereign debt crisis. So just to add also this little bit.
Thank you very much. Our time is almost over. You can have some time to one or two questions from the audience if anyone wants to make a question to our panel. Probably not. Well, in that case, we will end this session. Thank you very much for our members of the panel to participating in this discussion today. Thank you very much all. Good afternoon.